Well, this is an issue that's been bubbling along for a few days now in particular, and it's going to go on for a couple more weeks. New guidance on mark-to-market rules could allow financial firms some flexibility in accounting for the toxic assets poisoning their balance sheets. These rules require banks to attribute current prices to the value of their assets, even if they're going to hold them for the long term. And in this environment, that's meant write-downs of billions of dollars on their books. The rules have been widely criticised, at least partly being blamed for the current market woes that we're seeing. So would some change be a good idea? For his perspective, we're joined in the studio now by Alex Malley, President of CPA Australia. Alex, good to get you in the studio. Thanks for your time. And it's nice and early, so we appreciate you coming in. Just give us a sense of what we're seeing in this debate over the United States at the moment, because a lot of very well-known people, big organisations saying these mark-to-market accounting rules are virtually the reason we've got such big troubles in the market at the moment and with the financials. What's your view?
Sure. Look, our view is the inconvenient truth in all of this has been that large organisations, many of which have managed accountabilities poorly and risk poorly, and to suggest that asset valuation is the panacea for all the reasons that things have gone the way they have, to us is a nonsense. So what it's about is working through some obvious discussions about the fundamentals of a business, not necessarily a valuation change overnight will resolve the issues.
So you think it's almost been used as a scapegoat?
Well, I think it's being used as a variable, and I think it's unrealistic to assume that if an organisation's managed itself poorly for the 3 to 5 years, that all of a sudden, because we've got a market adjustment that's trying to reflect economic reality, that's the reason we've got the problem. That's an outcome of the poor management. It's not something that's been created in a point in time.
The actual rules themselves, though, giving current values to assets, even if you're going to hold them long term. I heard someone explain it just a couple of days ago. You know, you own a house, no way you're planning to sell at the moment, yet every Sunday you open up the auction results. How much is my house worth? Sure. It's pointless because you're not selling. So what's the point of looking at those prices and deciding what you're worth today?
Yeah. Look, in any market at any time you can criticise the valuation method, and we've been criticised in the past because we've used the principles of historical cost. That is, what you paid for it originally was the relevant amount, and we got criticised for that. So I think what we've got to do is get back at this time in the market to some economic reality. Investors and lenders want to know what is the reality of that organisation. And if some of that reality is giving you a very strong conservative position, that's far more powerful for an intelligent investor and an intelligent lender.
Alex, if you don't mind, we'll just leave you there for a second. We've been lucky enough to get someone on the line from the United States right now. It's Brian Battle. He's just joining us with the conversation now. He's from Performance Trust in Chicago. Brian, we've just been speaking with the President of CPA Australia, believing that perhaps the criticism of these rules has been quite unwarranted. You are in support of some sort of changes of these rules. Tell us why. What's your justification?
Sure, and I heard the comments there earlier, and he's right and wrong, certainly. Mark-to-market is part of the problem, and I don't think anyone wants to get rid of mark-to-market. I don't think anyone wants to get rid of fair value accounting, and we want full disclosure and transparency. So that's good for everyone to know what the market price of something is. But what's injurious to the system, what's causing all this pain that doesn't have to take place, is marking down assets that you intend to hold to maturity, and then reflecting what the distressed price is in the marketplace. So if something's worth 98, you've written it down to 90, and the bid side is 50, that sucks capital out of the banking system for an accounting ledger entry. It's real capital. Capital takes a long time to build up. So I agree. There are bad banks, there are bad financial institutions, there are bad assets. We need to deal with some of that. But this has leaked over into good assets that are performing, that have been taking a downgrade in price in this current environment. So we're making it worse. So throwing gasoline on the fire, I've heard it described, that's close. But we should be able to tease out the good assets from the bad assets if we change a little bit how we do the fair value accounting. It's real technical. It has to do with OTTI. But mostly it's about writing down the credit part, which we should, whatever you're going to lose, but don't be forced to write off the liquidity part out of your capital. And that's where the debate lies. Should you be writing down to the last worst price? And we think that's probably a bad idea.
Alex, do you think we should be writing down to the very worst price?
Well, I think, first of all, it's about business fundamentals. So the focus should be on the business itself and how it's running and how it's operating. And I think that's where investors and lenders need to go. So that's my first comment. The second one is that accounting standards and all of the processes around that are done over time in a context and in a proper process. The concern is that to start selecting certain assets to make changes at this point in time without looking at the whole context has a danger to it. So at this point, yes, it's an unusual market, but the reality is that, like all markets, it's a timing issue. So if we have a consistency at the moment, even if that consistency is inconveniently a little uglier than perhaps people think it should be, there is a consistency. Once you start allowing changes selectively, that can create less confidence in people saying, well, how was that new valuation determined? Where does that fit in the system? So for consistency and transparency, I think if we're going to look at this issue, it has to be done through proper process, and that takes time. And
Brian Battle from Performance Trust, you know, we don't have this debate, do we, in the boom times when assets are all good, and, you know, why now, just when it doesn't suit, if you like?
Right, and I'd like to address his point right there, too, is that we are looking at the business fundamentals, but it isn't inconvenient. We're burning down the banking system in the United States. You know, we're pouring in taxpayer capital, billions of dollars, hundreds of billions of dollars, and it's draining out of the bottom. We're trying to fill an accounting hole with real-life taxpayer money. So we have to address whether or not that accounting loss is real or not. I'm not suggesting that, oh, let's go easy on the banks because they're having a bad go of it. I'm saying let's recognize that the inherent value, disclose fully what the market value is, but don't write down to that. Let the investors decide. So we all have to agree that this accounting system probably had something to do with the bubble. You know, assets were overpriced in the bubble. This is the pro-cyclical part of the accounting system. It's obviously going to make stuff be underpriced when the market goes the other way. I think we're probably saying the same things. I don't think we want anyone to be taken easy or let's look the other way while the damage is being done. But we've got a real live accounting problem that's going to just drain all the capital of the U.S. banking system. And this is an accounting regime or the way to look at mark-to-market, which is not going to go away. You know, these are long-term assets, and once they're impaired, they don't get unimpaired. We're going to have to address this because we're going to have this problem going forward. It's really an accounting problem on a specific set of assets. Like I said, I'm not talking about bad bonds. I'm not talking about bad securities, subprime, subordinated CDOs. The whole accounting system for securities needs to be looked at, and we do need some relief because it's causing real damage. And with all this capital going out of the system, it's keeping banks from lending. If they know that their capital could get sucked away for an accounting entry, they're not going to lend. They're going to hold their capital dear. They're going to hang in there and be in a self-preservation mode, and that's preventing lending, which prevents the economy from recovering, and then you're back in the same cycle again.